This Honest Money podcast is brought to you by Prescient Investment Management, informed by science, guided by insight. Prescient Investment Management is a registered financial service provider.
Welcome to another really exciting episode of Honest Money for me. We're talking about one of my all-time favorite topics, and it's quite specific to investments. We're talking about the importance of asset allocation, and I'm going to explain that now. So don't switch off if you think this is going to be dry and boring, because I'm joined by one of my good friends, one of South Africa's investment distribution gurus, Ray Mhere from he's head of retail at Prescient Investment Management. So let me start by saying thanks for joining us, Ray. It's great to have you on the show.
Thanks, Warren. Great to finally get the invite.
Long overdue. I apologize, but we needed to make sure we had a good topic for you. So just for our listeners, when we talk about asset allocation, what we're talking about is that combination of cash, bonds, property, and shares, and how you put that together in an investment portfolio. And it could be in a million different ways. I mean, we're not prescriptive in terms of saying to people it can only be done in exchange-traded funds or it can only be done in unit trusts. It's really more important to say, as an overall, if you're an investor, this is something really important to focus on. So maybe just to kick off, Ray, I mean, it sounds like a dumb question, but I think there are no dumb questions in investments. Why is it important?
Well, Warren, I think asset allocation is important because it basically mirrors your goals and needs to your investment approach. So what I mean by that is asset allocation is an investment strategy that helps you to balance risk and reward in your portfolio of assets. So, for example, if you are a short-term investor and someone who's looking to invest in buying a car next year, you probably don't want to expose your assets to a lot of volatility, and you want to be in something that is a little more short-term, so you can buy, so that the market doesn't affect the value of your money, so you can buy the car or go on holiday next year. Whereas on the other hand, the same investor wanting to invest in retirement in 20, 30 years from now is probably going to want to invest in something a little more aggressive than just cash, because they're only going to use that money in a few more at the age of 55 or older.
Okay, so I mean, I must say, for me, it's a key question I get from people, very often is, I've got 3 years to buy a car. I've got cash now that I want to set aside for the car, so I'm just going to put all my money in the stock market and let it grow as much as possible. And what you're saying is, if I've got a 3-year goal and I put all the money in the stock market, I could get to 3 years time and my money is lost. Let's say I had 300,000 ready for the car, and suddenly it's only worth 200,000 because the stock markets have fallen, and I'm not able to fulfill my goal. That's what we're talking about here: is choosing the right asset for the right objective.
Correct, and it's your goals. I mean, in terms of your objectives, as you say, the risk tolerance that you're willing to take, and also people must also remember to consider the time horizon that they have to invest, because that also affects what type of assets that you decide to invest in. More risky assets, you'll probably want a longer-term horizon so that if anything happens in the market, you've got time to recover. Whereas shorter-term goals, you can go into less risky assets, which won't give you the same kind of returns, but at least, like I said, your money is a little more stable.
Okay, so you're dropping some gems on us here, which I think we need to just expand on a bit. So you mentioned risk tolerance. So for someone who's starting out, that what you're talking about here is a psychological thing, right? This is about if the stock markets fall apart as an emotional reaction, are you also going to fall apart, or are you going to panic, or will you look at it and kind of ride through those? So I think that's a really important factor, because it's not something a fund manager or a wealth manager or financial planner can tell a person. It's something that's built into each of us. We are the only people that will know our own risk tolerances, and sometimes only through experience. But it's a key factor, as you say. I mean, I think if you have no tolerance for risk, and you say, I can't deal with my money, going backwards at all, even if it's for a week or a month. It has a huge impact on your ability to invest in shares, as an example, because shares are going to give you the best capital growth over a decade or two, but in the very short term, it could be the thing that loses you the most money.
Correct, and when you're thinking about it, when people think about asset allocation and how it helps you to kind of prevent yourself from having those, I call them heart attacks. There's some people who look at their portfolios every couple of days and then they see that it's gone up or down, and I suppose that's the measure of risk tolerance, is can you handle the emotional roller coaster of watching your assets go up and down over any period of time. And what asset allocation does for you, it kind of smooths out that kind of return that you get by investing in different types of investment assets. So in any kind of portfolio, different assets will react differently during different periods of any kind of market or market cycle. And so at some times there'll be winners, at other times there'll be losers, but it's very hard to pick which one is going to do what at any given point in time. So the point of asset allocation is to put those winners and losers together. And what they do is they kind of smooth out your return so that you have a smoother ride to get to the goal that you want to get to.
So if we think about this, in a very practical way, you might have some money sitting in a money market fund, and you see it going up day after day, month after month, year after year, and it feels like you're a hero here because your money is making a little bit of money every day, and that's fantastic. You never see this roller coaster ride that you're talking about, but the problem with that will be that you also don't see kind of a tweet or a headline saying, hey, your buying power of your money has just fallen apart over the last year because inflation has eaten away all the buying power of your money. So if you have, let's say, some money in a money market fund, I don't think either of us would ever tell people to have zero cash. To have a little bit of cash is always a decent idea. But if you have some cash and you combine that with some shares, what that means is that when shares are booming and going really well, your cash might not be doing any better than it was doing last week or last month or last year. But when stock markets are falling apart, which they will do from time to time, your cash is still going up. So you've got two things in a portfolio that are moving very differently from each other and actually have different jobs. But the combination of the two, I think, I always say, if you get that mix of the assets right, and it's not just cash. We need to talk about bonds, government bonds and maybe property companies as well. But if you put those together, you kind of get to the point where 1 + 1 gets you to 2 1/4, and that's really what we're looking for in the investment world.
Correct, 100%. And one of the other consequences that you get from good asset allocation means that by getting that kind of smoother return where you've got a well-balanced portfolio, it also, if you think about the average investor, we tend to chase performance. We want to pick last year's winner and move and switch our money left, right, and center, chasing performance. But similar to timing the market, it's very difficult to invest in last year's winner and expect it to carry on winning. And when you do the right asset allocation, or your asset allocation is correct, what you find is by having that smoother return, you're less inclined to start chasing returns every single time because the volatility of your portfolio has been reduced as a result of having a good mix of assets in your individual portfolios. So I suppose that's another benefit of having great optimal asset allocation.
Now, the nice thing about especially the unit trust world is it's actually been built with this in mind. If you look at the categories of unit trusts that are out there, they actually kind of design types of unit trusts to suit investors who have different time horizons. But that would be one category, but also different tolerances for risk and different investment objectives. So I always think of my kind of two favorite broadish groups of unit trusts for investors is a typical kind of balanced fund. It might not say balanced fund as the name, but if you look at the balanced fund category, I think the unit trust language for that is, what is it? High equity asset allocation. What you're looking at inside there is, a fund that can have a very significant allocation to shares. It could probably range from 40 or 50% right up to 75, but it also does have shares, cash, government bonds, property companies, and then both local and global exposure, and it's all sitting in one portfolio where a fund manager or a fund management team are managing that quite rigorously in terms of not over allocating you to shares because they've got restrictions. If they're in a balanced fund, they can't have 100% in shares. They also can't have 100% in cash. So if you're a client of a fund like that, it means that you already know the range of outcomes that you could get, how much you would have in shares in good times or bad. But it also gives you the ability to do some kind of not forecasting is the right word, but some proper planning to say, well, I've got 10 years for this money, and so my balanced fund is a good objective for that. I think also I'm never sure of these names; they change all the time. But let's call them the cautious or moderate kind of funds, where they've got a much lower allocation to shares. Let's say they'll range up to a maximum of maybe 40 or 50%. And those kinds of funds have a much bigger allocation to bonds and property and cash. And the idea there is they're not going to get you the same capital growth over long periods of time, but they are good for investors who really can't tolerate a lot of risk. And they're probably also good for people that have got a shorter time horizon, let's say kind of up to that 5-year horizon. So it's good for me, I think, when we look at this to kind of make it quite concrete for people. And I think those are two very nice kind of concrete examples of how you can get an asset allocation and make the big decisions for yourself, but then hand over the kind of more day-to-day allocations to a fund management team.
Correct. And the trick with getting your asset allocation right is once you've determined the right mix of, the assets, whether it's property, shares, bonds, or cash, that suits your goals, kind of your investment time horizon and the risk that you're willing to take, is you need to remember that in any investment portfolio, that same asset allocation will not stay the same because, like we said earlier, the different assets will perform differently. So by outsourcing that kind of management to a fund such as an asset allocation fund that you're talking about, those managers' role is to make sure that the asset allocation stays within the band that you want to be in. Because if you leave it to yourself, you have to constantly remember to rebalance your portfolio in order to stay in that correct asset allocation. So it is a great idea to look at those balanced funds, stable funds, or cautious funds like you call them, because those assets, you're paying someone else to do it for you and to remain in the asset allocation that is optimal for you given your personal circumstances. It's obviously very difficult to find for those kind of funds to accommodate every single person's individual needs, but they're more or less working in a band that is suitable for people in similar categories.
And I think that you make two key points there. One is you can't, as an individual, you can't outsource the entire asset allocation decision to a fund manager or fund management team that know nothing about you. It's impossible for them to know every single individual investor. So it is important that when you're deciding on the investments that suit you best, you've got to make that call as the investor to say, for me, for my requirements, a balanced fund is ideal. And then you hand over the kind of day-to-day to the fund management team to then go from there and make the best decisions they can within that range that you've mentioned, that band of allocation to the different asset classes. But I hear a lot of critique sometimes of asset managers where people say, well, they got it completely wrong. The fund managers didn't know what was going on with the markets. And it's important to know that if you allocate money to a balanced fund manager, that fund manager can never have 100% of your portfolio in cash. They're not allowed to do that. And it's certainly, I think that they'd be in breach of regulations if they did. And if I was their boss, I'd fire them because the job there is, to run with a high proportion of shares, but they can reduce the allocation to shares. That's certainly possible. And if they think the stock market's very cheap, they can increase the allocation to shares. That's what we're paying them to do. But certainly we're not paying them to know what's going on in each individual's life and then try and match one portfolio for thousands of different individuals. That is the job of the individual allocating the money to the fund. And that's the control I think you always need to have if you're an investor in a fund or a range of funds. So if we're in this space, I think it's important also just to talk about the ability to allocate that money both globally and in South Africa, right? So if you're in a balanced fund, you're not restricting someone or a fund management team just to SA assets. They've got the ability to allocate money within a range, again, to the SA markets or global markets. Yeah.
So what the beauty of asset allocation funds in South Africa is they allow those managers to do quite a few things. And in fact, earlier on this year, National Treasury actually announced that pension funds and any kind of investments managers who manage those balanced and stable funds are allowed to take a little more money offshore. Now, it doesn't mean that they have to. It just means that they can allocate what used to be 30% in global shares and 10% in the rest of Africa. Now they're allowed to allocate 45% of your money into global shares, including Africa. I suppose, depending on how you feel, I don't look at that kind of global asset allocation as a call on whether you believe South Africa is the right place to invest or not. I think being able to allocate your money globally in general is a great thing. So if you can invest in US tech shares or shares in China tech shares, is stuff that we don't have here in South Africa. So the more diversified your portfolio is, the better. And the beauty, again, of being in an asset allocation fund is that these asset managers have all of that at their disposal. So they're the ones that go out and try and figure out where the best place to be. So making a call to be in shares is just not only a call about South African shares and which shares. It's actually whether South African shares, global shares, what type of shares. There's still a lot more decisions that have to be made once you've made the decision to allocate that portion of your money into shares. And outsourcing it to an investment manager who can do that means that they have the expertise to decide how much goes where and into what sectors.
Yeah, and I think it's also key there that if you're in the space of building up a global portfolio, just understanding again that I know we're talking about balanced funds a lot, but the same would apply to the sort of the cautious stable funds as well. Is the fund managers again operate within a restriction. So if they can get the 45% global allocation and they feel that that's what's correct for the fund, that's all they can get. So if you need additional offshore allocation, and that's what you need to suit your life and your objectives, then you need to get it outside of the fund. That's a separate decision, and it's something you as an investor should take control of. But I think that global local allocation in a balanced fund is important. And I think you make the point. It's not a decision about avoid SA or a call on the South African economy or stock market. It's a call on saying where are the best opportunities to get the most diversification. Again, the only free lunch in the investment world for me is that diversification argument. About making sure you've got a proper spread of assets, both in terms of cash, bonds, property, and shares, and then also the local and global markets, and taking advantage of all the opportunities you can and spreading your risks as far and as wide as you possibly can.
Absolutely. And I think that the more, like you said, if you don't have, I think people should also be aware that you don't have to, obviously in the pension fund space or in a retirement annuity where you are forced to be in a Regulation 28 kind of investment. So Regulation 28 is the prudential guidelines that we've all been given in terms of how much we can invest in shares, property, offshore and local. So whatever you don't get out of there, Warren, I think you make a great point in saying that there are other options available to you. So what you do in your pension fund, you could do something completely different in your other investments. And that's why people do have different types of investments for different reasons.
So we're rapidly approaching extra time in our episode, and I wanted to just check in with you, Ray, if there are any other main points that we need to kind of highlight to our listeners around asset allocation.
The only research has shown that asset allocation is probably one of the most important things in any investment portfolio or in any one of your biggest investment decisions that you make. It's probably more important than what actual shares you invest in. So I suppose the last thing I would like to say is that in terms of asset allocation, when making the decision of what to allocate, where to allocate your money, once again, I urge people to think about the three things, which is what are your goals, what's your time horizon, and how much risk are you willing to take to achieve that. That will probably help you determine where you should allocate your money. And as Warren said, obviously, the biggest, the thing that you want to avoid the most in investing is not beating inflation, but at the same time, don't blindly go into shares because you think you're going to make more money when you actually don't have either the stomach for it or the time horizon for it.
Yeah, thank you. I agree with that 100%. It's, I think in the investment world, it is a complicated place to be, changes all the time. And there are lots of things happening, and lots of new kinds of investments that we either need to look at or ignore. And we're always faced with a huge influx of news and often a lot of noise. But the one key, the one golden thread through all of this is if you get your asset mix right, you've achieved, I think, around 80 or 90% of the investment game. And I couldn't agree with Ray more. I think it is the thing to focus on, and it is important to understand that it's your life and your dynamics which determine your asset allocation. It's not based on what you think the markets are going to do next week, because that's a surefire way to kind of take yourself off the path to financial freedom. So on that note, I'm going to wrap it up. Ray Mhere from Prescient Investment Management, thank you so much for joining us. I'm very sure we will have you on the show again.
Thanks, Warren, and thanks for the opportunity.
Prescient Investment Management, informed by science, guided by insight. Prescient Investment Management is a registered financial service provider.